going from football onto the markets, and they're a bit more volatile perhaps than the soccer we're seeing at the moment. Yesterday we were chatting, the market had turned briefly positive. As we chatted on the phone, it just went all the way back into the red again, and that was with the latest spate of economic data coming out of the United States, and not boding very well for the global economic recovery.
No, I mean, we were chatting at 4 o'clock and it was ISM data that came out, and I mean, the prices paid, market was looking for 70, they got 57 from a previous 77.5. The ISM manufacturing, which is kind of your PMI, they were looking for 59, they got 56.2, still above 50, still growing, but disappointing to the market in that response. And certainly I mean, we're also seeing the significant move in the euro and oil seems to suggest to us that a month ago, a week ago, on Monday, the sense was, you know, Europe is toast, flee to the US. We're seeing data out of the US. People are now saying, whoa, hang on, is the US completely immune to it? Short answer, it's absolutely not. So we're seeing some flight out of the US back into Europe.
Now, we saw that dollar weakening against the euro up to about 125. At the same time, we saw the gold price coming off sharply. Now, this is a gold price that traded above $1,260 an ounce just 2 weeks ago, now trading just above $1,200. Wouldn't you have expected, just given the risk aversion in the market, given the weakness of the dollar, we would have seen the gold price improving? We would have.
At this point. I mean, you absolutely expect a significantly stronger gold. And gold's a strange beast. It keeps on, I mean, make no bones, it's still $50 odd off its all-time high. That's not insignificant. Inflation adjusted well below, but it keeps on not doing what we expected when we expected. If we go back to the real crisis in late 2008, gold was falling at the same time that the Dow was falling, that Europe was falling, that the wheels were coming off our financial markets. And you kind of think yesterday you would have expected gold to be back at those highs. It wasn't. Obviously there's selling happening, and potentially it's that everyone who's really bullish on gold has bought their quota.
And are they perhaps selling to cover losses elsewhere at this stage?
Well, that's exactly it. A margin call somewhere else, maybe you bail out, which is frankly not good trading. If you've got a margin call, sell on the loser, keep your winner. Your gold is probably your winner. But there has also, if you look at ETF purchases and the like, which is where most investors are getting their gold exposure via an ETF, those purchases really peaked in 08, 09, sort of plateaued this year. New gold, I haven't seen in the last week or two, but 2 weeks ago, the local ETF, New Gold, was actually not at its all-time high for holdings of the physical metal.
And of course, if you look at the economic data coming out across Europe, from China, from the United States as well, it doesn't look like inflation is going to be a problem anytime soon. In fact, they were talking about possible deflation in the US economy, and of course that would be a driver of the gold price if we had inflation coming through.
Yeah, inflation is still something we ponder about, but really it is on the horizon. It is far, far, far away. I mean, Ben Bernanke, as far back as January 2008, when he started slashing rates, commented that inflation was a risk, but it was a risk they would tackle when it arrived. There's no glimmer of it coming through at all. So that is one of the feeders into gold. But other issues such as default, general fear should also feed. Inflation really is your key driver, and it just isn't on the horizon.